Three assets closed out the week telling three different stories about the same Federal Reserve. Bitcoin back near 65,000, gold above 4,300, oil down more than 5%, and by the time markets reopen Monday, at least one of those stories has to be wrong. Good morning. It's Sunday, August 9th. I'm Nick Vertucci with Eleanor Whitfield and Marcus Brooks, and this is the Week Ahead edition. No scorecard on yesterday's calls today because Saturday's show didn't leave us fresh ones to grade. Instead, we're setting up the 5 sessions in front of us. The inflation data that tests everything the jobs report just built, an earnings slate that's almost entirely AI infrastructure, and the one Middle East story that could undo the whole calm mood by Tuesday morning.
Which is a lot to get through before Wednesday, frankly.
In a good way, though. This is a week that actually has stakes.
We do have one loose thread to carry over, even without a fresh scorecard. Dave's Datadog call from Friday is still out there, unresolved, and it's actually got a wrinkle now that we looked at the calendar. We'll get to that when we bring him in. First, the season record, quickly, so you know where everyone stands walking into this. Eleanor's 12-8 on the year, but nursing a 1-game losing streak after Friday's 10-year call came up short. Marcus is 11-9, riding a 6-game streak after nailing the Nasdaq's bad news is good news reaction. Sarah's 0-1, Dave's 0-2, both still building a track record in this chair. Everybody's got something to prove this week.
No pressure.
Says the guy with the 6-game streak.
Let's start with the setup because Saturday's whole show ended on an unresolved question, and I want to frame it before we get into the calendar. Eleanor, remind people where we left it.
We left it on the Russell 2000, best year since 2003, built substantially on companies that don't turn a profit, versus Marcus's case that broad market breadth and real commodity demand say this is an actual build-out, not a financing bubble. Neither of us moved the other. The tiebreak we gave listeners was credit spreads. Do they stay tight or do they start widening?
And nothing about this week resolves that on its own. But it's the lens I'm bringing into everything else we're about to discuss, so it's worth having said out loud again.
Fair? Hold that thought. We'll come back to it. Let's do the calendar. Wednesday's the big one.
Wednesday morning, 8:30 Eastern, July CPI, FactSet's consensus is headline up, 0.2% on the month, 2.8% year over year. Core, that strips out food and energy, is expected at 0.3 monthly, 3% year over year. Goldman's actually a touch hotter than that on both lines.
Why does a print like that matter more this month than a normal CPI Wednesday?
Because Friday's jobs report did a lot of work convincing markets a September cut is close to locked in. Negative 23,000 payrolls, 2 straight months of ugly downward revisions. If Wednesday's CPI comes in hot on top of that, the Fed's stuck holding a labor market that's breaking and an inflation print that isn't cooperating. That's the least comfortable combination there is for a central bank, and it's exactly the setup Wednesday could hand them.
I'd frame the stakes a little differently. I don't think a merely warm CPI print derails the cut. The Fed doesn't unsee 3 months of a weakening labor market because one inflation number came in 0.3 instead of 2. You'd need a genuinely ugly surprise. A half-point beat, not a rounding error, to put September back in real doubt.
I don't think it's that forgiven. The Fed's own meeting minutes already flagged more concern about inflation risk than employment risk. That's not us reading tea leaves, that's the actual minutes. CME's FedWatch has the odds of a 0.25-point September cut sitting near 72% right now, down from close to 99 just over a week ago. That's a real repricing, not noise. And it happened before Wednesday's number even printed.
72%, down from 99, in about a week. That's a big swing for one set of minutes.
It is, and I'll admit that's more movement than I'd have guessed, but percent odds swing in positioning too, not just conviction. A lot of that could unwind right back the other way if CPI comes in soft Wednesday.
Give me the extremes so listeners know how wide the range really is.
JP Morgan Wealth Management is out with the true outlier call. They're now saying the Fed hikes a 0.25 point in September, not cuts. That's a real institution, not a fringe call, and it tells you the dispersion out there is wider than the headline odds suggest.
I think that call ages badly for what it's worth, but it's useful precisely because it shows you the range of opinion isn't just cut versus hold. Some serious people are still on hike.
And there's a Fed speak angle underneath this too, right? Actual officials pushing back.
Cleveland's Beth Hammack and Atlanta's Raphael Bostic have both been out recently saying they wouldn't support a cut if the vote were held today. So you've got two sitting regional presidents on record, hawkish, a JP Morgan hike call on the fringe, and market odds still favoring a cut 2-1. That's not consensus. That's a genuine fight. And Wednesday's number is the next data point in it.
Thursday then, PPI.
Producer prices. Thursday morning, same 8:30 slot. This one matters because it's the upstream number. It tells you what's in the pipeline before it shows up in what consumers pay. If PPI runs hot the same week CPI runs hot, that's confirmation, not noise, and it makes Wednesday's number a lot harder to wave off as a 1-month blip.
And if they diverge, say, CPI's fine, but PPI's hot. That's actually the more interesting case, because it means the pressure's building somewhere it hasn't hit consumers yet.
And then Friday closes the week with retail sales.
July retail sales, Census Bureau, Friday morning, 8:30 again. This is the read on whether consumers are actually pulling back the way a jobs report that ugly would suggest they should be, or whether spending's holding up despite it. If retail sales are soft on top of a bad jobs number and a hot CPI, that's 3 legs of the same stool. A real slowdown, not a headline scare.
And retail sales holding up despite a bad jobs print is actually the scenario I'd watch closest, because that's the one that breaks the recession fear framing entirely and turns us back into a clean rate cut story with nothing else attached to it.
So, CPI Wednesday, PI Thursday, retail sales Friday, and by the end of the week we'll actually know whether Friday's jobs number was the start of a slowdown story or a one-off. Eleanor and Marcus, quick, what does each of you need to see by Friday to feel like your side of Saturday's argument is right?
Spreads stay wide as any of these numbers disappoint, and at least one of the 3 CPI, PPI, or retail sales actually confirms the cooling story instead of just the jobs number alone.
I need the opposite. Retail sales holding up, and no material widening in credit even if CPI runs a little hot. That tells me this is a rate story, not a fear story.
There's your test, if you want to keep score yourself going into Friday. Now, earnings, because this might be the most AI infrastructure heavy week of the whole summer. Monday afternoon alone, we get CoreWeave and Supermicro.
Which is why I want Dave in the chair for this one. We've pulled him back into the 4th seat because honestly, 4 of the 5 big prints this week are squarely his beat.
Dave, welcome back. One day after your own call went on the board unscored. Set the week up for us.
Happy to, and yeah, we'll get to my own mess in a minute. Monday afternoon, CoreWeave and Supermicro both report after the close. CoreWeave's the one everybody actually cares about. It's the clearest read on whether the AI cloud backlog people keep pointing to as evidence this is real is actually converting into revenue, or just sitting there as a promise. Supermicro is more of a hardware margin story. Server shipment volumes and whether they're keeping pricing power in a crowded rack supplier market.
And Wednesday is a doubleheader too, Nebius in the morning. Cisco after the close, the same day as CPI.
Right, brutal scheduling if you're actually trying to trade any of it live. Nebius is basically CoreWeave's European cousin. Same backlog conversion question, but with a sovereign AI angle. European data centers built partly on national security money, not just enterprise demand. Cisco's the week's actual headline large cap. The street's looking for mid-teens revenue growth on AI networking orders, the switches and routers that sit underneath every one of these AI data centers everyone's been talking about all summer.
Thursday, JD.com.
The odd one out? That's the Chinese consumer print of the week, not an AI story at all. Category commentary on big-ticket electronics and appliances is the thing to watch there. It's more of a read on Chinese household spending than anything to do with chips or clouds.
And Friday closes with Applied Materials, the same morning as retail sales.
Applied Materials is semiconductor equipment, the tools that make the chips one layer back from NVIDIA and AMD. Consensus is $3.39 a share, revenue around $9 billion, up something like 23% year over year. If that print's clean, it's a genuine tell that chip demand is still accelerating at the equipment level, not just at the chip level. That's usually a leading indicator, not a lagging one.
Which ties directly back to the guidance reckoning thread from all week. We watched Palantir get rewarded for raising, and AMD, Sullivan, HubSpot, and Trade Desk all get punished for merely meeting. 5 names this week are about to get the same test.
And I'd bet the pattern holds. If CoreWeave and Nebius just confirm what's already priced, decent growth, inline guide, the market's going to want more than that after the week we just had. The bar's higher now, not lower.
Agreed, and that's actually a clean setup for my own call, since Nick's going to make me address it eventually anyway.
Go ahead, the Datadog thing.
So, Friday, I said at least one more AI-native software name discloses meaningful single customer concentration risk within 2 weeks of Datadog's scare, and if that happens, Eleanor's side of that argument, that this is structural, not a one-off, wins. I picked Snowflake and MongoDB as my test cases because they're the next 2 AI-adjacent software names reporting.
And the wrinkle?
I actually pulled the dates before this show and I got my own math wrong. Datadog reported Wednesday night, so 2 weeks from there is around the 20th. Snowflake reports August 25th. MongoDB's the 27th. Both land after my own deadline.
So, your call doesn't even resolve by your own rule?
No, it doesn't, and I'll own that. I should have checked the calendar before I made the bet Friday morning, not after. What I'd say is, the spirit of the call still stands even if the letter doesn't. Watch anything. AI adjacent that reports this week. CoreWeave, Nebius, Cisco, for the same kind of concentration language Eleanor flagged in Datadog's print. If nobody says a word about customer concentration this week, and then Snowflake or MongoDB do at the end of the month, that's actually stronger evidence for Eleanor, not weaker. It means it's spreading slowly, not contained to one print.
I'll take that reframe. It's honest, and it's actually a fair test either way.
Good. Own the miss. Extend the bet. That's the show working the way it's supposed to. Dave, one more thing while you're here. Cisco's networking numbers, does that print tell us anything about the AI CapEx debate broadly?
It's actually one of the better broad reads, because Cisco sells picks and shovels hardware to basically everybody building AI infrastructure, not just one hyperscaler. If their AI order book is still growing mid-teens, that's a vote that CapEx spending is real across the industry, not just concentrated in 2 or 3 companies burning cash to keep a growth story alive.
All right, thank you, Dave. Stick around if you've got a closing call for us later. Let's turn to the story that can scramble literally everything else we just laid out. Iran.
This is the one I'm most nervous about heading into the week, because it's the least under anyone's control. Iran and Oman have reportedly agreed on the actual geographical coordinates for a safe shipping corridor through the Strait of Hormuz. That's real, specific progress, not just talk. The U.S. was reportedly aiming for an announcement as early as this past Wednesday.
And Trump's been saying publicly the strait reopens soon, and that talks with Tehran are going well.
Right, except Iran's own deputy foreign minister denied, again, that Iran is negotiating directly with the U.S. over the waterway at all. That's the same gap we flagged in the notes going into this weekend, and it hasn't closed.
So what's actually agreed and what isn't?
What's agreed, apparently, is the Iran-Oman piece. Shipping routes, coordinates, the technical mechanics of who can move a tanker where. What's not agreed, or at least not confirmed, is the piece that actually matters for oil markets, whether the U.S. and Iran have a real deal with real conditions met that lets the strait fully reopen. An Iran-Oman shipping lane agreement by itself doesn't do that. Iran's been clear the U.S. has to meet additional conditions first.
Which is exactly why oil fell more than 5% into the weekend on the de-escalation headlines, but I'd caution against reading that as resolved. We said this Saturday about the whole Hormuz story, headline fragile, not resolved, and nothing that happened since changes that. One denial from Tehran, and the risk premium's right back.
So what's the actual trigger to watch this week?
Any formal joint statement. U.S., Iran, and Oman all confirming the same terms at the same time. That's different from Trump saying soon or Oman and Iran agreeing bilaterally. Until all 3 sides say the same thing, oil's exposed to a reversal on any single quote.
Agreed on the trigger. Where I'd push back slightly is on how much of the weekend's other moves actually depend on Iran resolving cleanly. Gold above 4,300, Bitcoin near 65,000 are a rate cut story. Mostly, that trade doesn't really care what happens in the Gulf. Oil is the one asset actually pricing Hormuz, risk directly.
That's actually the tension from the cold open. 3 assets, 3 different stories, and you're telling me 2 of them barely talk to each other.
That's exactly right, and it's worth sitting with for a second. Because it's easy to read risk on weekend as one story when it's actually 2 unrelated ones running in parallel, a Fed cut trade in gold and crypto, and a geopolitical unwind in oil that could reverse independently of anything the Fed does Wednesday.
Okay, that's the setup. Before we get to closing calls, one real quick human moment, because I need it after that much macro. Eleanor, coffee order. Be honest.
Oat milk cortado, and I will not apologize for it.
I drink mine black, out of a mug that says World's Okayest Analyst, which my nephew got me as a joke, and which I now use unironically every single day.
That's genuinely a little sad.
It's load-bearing at this point.
All right, back to it. Closing calls, and remember, these are for the week. Checkable by Friday, not just Monday. Eleanor, you first.
Mine's on the 10-year. If CPI and PPI both come in at or above consensus this week, I think the 10-year closes Friday above 470, because that's real confirmation the Fed's inflation worry outweighs its jobs worry. And the Hawks, Hammack, Mostick, the whole camp get louder, not quieter. If both prints come in softer and line, I think it holds under 460, closer to where it settled Friday.
Marcus.
Mine's on the AI infrastructure basket, specifically CoreWeave and Nebius. If both companies show backlog actually converting to revenue this week, meaning the growth rate on realized revenue keeps pace with what they've been promising on signed contracts, I think the group grinds higher into Friday regardless of what CPI does. If either one shows backlog outpacing revenue conversion, meaning the promise is growing faster than the delivery, I think you see the same guidance reckoning sell-off we watched hit AMD and Sullivan, this time hitting the neoclouds.
Dave, your extended call stands as amended. Anything else, or is that it for the week?
That's it. I'll let the amended version ride. Watch the language on customer concentration in every AI-adjacent print this week, not just my two original names.
3 checkable calls. The 10-year, the AI infrastructure basket, and Dave's concentration risk language, still looking for its full resolution later this month. Here's the week in one breath. Wednesday's CPI is the first real test of whether Friday's ugly jobs number was the start of a slowdown or a one-month scare, with Thursday's PPI and Friday's retail sales filling in the rest of that picture. CoreWeave, Supermicro, Nebius, Cisco, JD.com, and Applied Materials give us 5 straight days of the exact question Saturday's show never resolved. Is this AI build-out real demand or a financing story running on faith? And Eleanor and Marcus each told you exactly what would prove them right. And Iran stays the wild card, real progress on paper between Iran and Oman, a flat denial out of Tehran that any of it involves Washington directly, and oil sitting exposed to whichever headline lands first. If the show's useful to you, follow Nova Ventures Daily wherever you get your podcasts, and find our written notes at novaventures.us for the deeper dive on any of this. That's your Sunday setup. Have a great week, and we'll see you tomorrow morning.